Hello everyone, I am Pratika Joshi and today I'll be discussing about the introduction to recent trends in microfinance, that is innovation, regulation and sustainability. So basically, let's know about what is microfinance. So microfinance refers to the provision of small-scale financial services to people who do not have any access to traditional banking systems. So these services are mainly designed for low-income individuals, rural households, women entrepreneurs, small vendors, and informal workers. So, unlike commercial banks, which require higher documentation and collateral, microfinance institutions provide small loans, savings facilities, microinsurance, money transfer services, and digital financial services. So now let's talk about digital transformation from field offices to mobile platforms. So as today in changing world, digital transformation in microfinance, it's like earlier microfinance operations were mostly manual and field based. Loan officers had to visit customers physically for loan applications, verifications and collection. This process was time consuming and costly. Now with digital transformation, many services are available online through mobile platforms. So mobile loan origin allows customers to apply for loans digitally, reducing processing time and making services accessible even in the remote areas. Now let's moving towards digital KYC and Aadhaar authentication. So it have simplifies customer verification. It reduces paperwork, lowers compliance costs, and enables quick remote onboarding. And additionally, we have online repayments and digital wallets, which improve the collection efficiency and reduces risk associated with cash handling. However, there are many challenges such as digital literacy gaps, poor internet connectivity, and cybersecurity risks, especially for low income users. Let's now talk about institutional growth, that is MFIs evolving into banks. So many MFIs scale into regulated entities like small finance banks or commercial banks, which benefits include greater capital access, deposit taking ability, and formal sector integration. So it includes stability, strong governance and risk management frameworks, inclusion, broader product range and regulated deposit services scale. So it has the ability to serve more clients for funding. So as we know, from group lending to data driven individual credit. So there is a traditional joint liability models which remain relevant, but digital records and alternative data enable individual lending and tailored credit products. Data-driven scoring uses transaction history, mobile usage, and digital footprints to access the credit worthiness. For example, Grameen style groups continue where social collateral is strong. Fintech scoring complements group models in urban and peri-urban contexts. So, talking about the regulation and borrower protection, so policymakers emphasize more on transparency, preventing multiple borrowing and fair collection. So, stronger oversight, example RBI in India, builds market trust and reduces predatory practices while balancing outreach and sustainability. It has clear disclosure of APR and fees. It limits on coercive recovery and also accessible grievances to redress the channels. It has transparent rates, then fair recovery and grievances at readdresses. So talking about product diversification, so it manages the risk and build resilience. So savings, so it can encourages liquidity buffers and also reduces reliance on credit for shocks. Then microinsurance covers health, crop or wealth risk, protecting repayment capacities. Now, last is financial literacy. So it increases the product uptake and responsible borrowing behavior from the lender. So emerging risks like climate and urbanization. So climate shocks, for example, um, droughts, floods, it erodes the rural income and rise in default risk. Urban migration expands informal sector clients with volatile incomes. So MFIs must incorporate climate risk screening and design flexible repayment schedules. Then integrate climate risk assessments into credit decisions. It should also offer the index-based insurance or climate adaptive loans. Then design the products for irregular urban incomes, that is micro payday and flexible installments. So it is concluded that microfinancing is shifting towards digital, diversified, and regulated models that can be broaden inclusion while managing risks. Then sustainable progress requires balancing regulation, client protection, climate aware products, and investments in digital literacy and security. So for practitioners, prioritize client education, robust data practices, and flexible products. For policymakers, it mainly focuses on transparency and regulation. Then for researchers, study impacts of digital scoring, climate finance tools, and product diversification and household welfare. Thank you.